Imagine walking into your favorite coffee shop on a normal Tuesday morning. You order your usual drink. The cashier smiles, hands you the receipt, and says, "That'll be $6.75. You reach into your wallet, pull out a $20 bill, and place it on the counter. The cashier pauses for a second, then points to a small sign next to the register. Card or mobile payments only. No cash accepted. You look around. Nobody seems surprised. The customer behind you taps a phone against the payment terminal. The next customer uses a smartwatch. The line keeps moving. Your $20 bill suddenly feels like a relic from another era. Just a generation ago, cash was everywhere. People paid rent with it, bought groceries with it, filled their gas tanks with it. Parents tucked dollar bills into birthday cards. Kids carried cash to buy candy after school. For decades, cash wasn't just the most common way to pay. It was money. Today, that reality is changing faster than most people realize. Across the United States, more businesses are accepting only digital payments. Online shopping has become part of everyday life. Apps let you send money in seconds without ever touching a banknote. For millions of Americans, an entire week can pass without opening their wallet. So what happened? How did paper money, one of humanity's greatest inventions, begin losing its place? Is cash simply becoming outdated? Or is the world quietly entering a new financial era? Because when cash disappears, the change is about far more than how you buy a cup of coffee. It affects businesses, banks, governments, privacy, and ultimately the way every dollar moves through the economy. The future of money isn't arriving someday. It's already here, and understanding why cash is slowly disappearing may help you understand where the financial system is headed next. So, before we explore the future, we need to go back to the very beginning, back to a time before wallets, before credit cards, before banks, before money itself. Chapter 1. The Birth of Money. Long before paper bills and digital wallets, buying something was surprisingly complicated. Imagine you're a farmer with a basket full of apples. You need a new pair of boots. The local shoemaker has exactly what you want. But there's one problem. He doesn't need apples. He needs firewood. Unless you can find someone willing to trade firewood for your apples, you leave empty-handed. This was the biggest flaw of the barter system. For a trade to happen, both people had to want exactly what the other was offering at the same time. As towns grew into cities and trade expanded, this system became too slow and too inefficient. People needed something everyone would accept. Over time, different civilizations experimented with all kinds of objects: salt, shells, beads, even large stones. Each worked for a while, but none solved every problem. Eventually, precious metals like gold and silver became the preferred choice. They were scarce, durable, easy to divide, and difficult to counterfeit. More importantly, people trusted them. Governments later began minting coins with official seals, guaranteeing their weight and purity. For the first time, strangers could trade with confidence. Commerce expanded, businesses flourished, entire economies began to grow. But carrying large amounts of metal wasn't practical. Imagine buying a house with bags full of gold coins. It was heavy, risky, and inconvenient. So another innovation changed everything: paper money. Instead of carrying gold, people could carry paper that represented value. As long as everyone trusted the institution behind it, that paper could be exchanged for goods and services just like precious metals. Over time, paper money evolved into the modern dollar. Today, every U.S. bill, from the $1 bill to the $100 bill, is issued by the Federal Reserve and accepted because people trust the financial system behind it. That's the secret most people never think about. A dollar bill isn't valuable because of the paper it's printed on. In fact, the materials used to print it are worth only a tiny fraction of its face value. The real value comes from something you can't hold in your hand. Trust. Every time you accept cash, you're trusting that someone else will accept it tomorrow. That shared belief has powered the American economy for generations. But trust alone wasn't enough to stop technology. As computers, the internet, and smartphones transformed nearly every part of daily life, money was about to undergo its biggest evolution since the invention of paper currency. The question was no longer whether people could trust paper. It was whether they even needed it anymore. Chapter 2. The Digital Payment Revolution. For most of the 20th century, cash ruled everyday life. If you wanted to buy groceries, you paid with bills and coins. If you wanted to fill up your gas tank, you reached for your wallet. If you wanted to pay a friend back, you handed them cash. It was simple, it was familiar, and for decades, nobody seriously questioned it. Then, technology changed the rules. The first major shift came with credit cards. Instead of carrying stacks of cash, people could carry a single piece of plastic that gave them instant purchasing power. Suddenly, paying became faster, safer, and more convenient. Banks loved it. Merchants loved it. Consumers loved it. But that was only the beginning. The internet transformed shopping forever. People no longer had to drive to a store. With just a few clicks, they could order almost anything from home. Cash couldn't be used online. Digital payments became a necessity. Then came smartphones. What started as devices for calls and text messages quickly became digital wallets. With services like Apple Pay, Google Pay, and other mobile payment apps, buying something became as simple as tapping a phone. No cash, no physical card, just a few seconds. The COVID-19 pandemic accelerated this shift even further. Many businesses encouraged contactless payments to reduce physical contact. Consumers who had never used mobile payments suddenly found themselves relying on them every day. Once people experienced the convenience, many never went back. Today, paying someone can take less than 10 seconds. You can split a dinner bill, pay your rent, send money to a family member, or buy groceries without ever touching a dollar bill. Behind every tap, swipe, or online purchase, billions of dollars move through digital networks every single day. To most people, it feels effortless. But beneath that convenience lies a massive financial system connecting banks, payment processors, merchants, and technology companies around the world. And here's something many people don't realize. Every digital payment creates a record. Unlike cash, which can change hands anonymously, digital transactions leave a trail. Where you spent your money, when you spent it, how much you spent. That information has become incredibly valuable, not just for banks, but for businesses, advertisers, and governments. Convenience has made digital payments almost irresistible, but convenience isn't the only reason cash is disappearing. There's another group benefiting even more from the decline of paper money: businesses. And their reasons may surprise you. Chapter 3. Why businesses want you to stop using cash. If you've ever seen a sign that says card only or no cash accepted, you might assume it's simply about convenience. But for many businesses, the decision goes much deeper than that. Every cash transaction comes with hidden costs. At the end of each day, someone has to count the money, match it against sales records, prepare bank deposits, transport the cash safely, and hope nothing is missing. Large retailers often spend thousands of hours every year simply handling physical money. Then there's the risk of theft. Cash registers can be robbed. Employees can make mistakes. Counterfeit bills can slip through unnoticed. Every dollar in cash requires security, insurance, and careful management. Digital payments eliminate many of those problems. The money moves automatically. Sales are recorded instantly, inventory updates in real time, accounting becomes faster and more accurate. For business owners, that's a huge advantage. But there's another reason businesses love digital payments. People tend to spend more when they don't physically hand over cash. Think about the last time you paid with a credit card. You probably tapped your card or phone in just a second or two. Now compare that to paying with $20 bills. When you count out physical cash, you actually feel the money leaving your hands. Psychologists call this the pain of paying. Studies have found that people often spend more when using cards than when using cash because the transaction feels less immediate. You're not watching your wallet get thinner, you're simply tapping a screen. For businesses, that can mean higher sales. It's one reason digital payments have become so attractive. Then there's speed. A customer tapping a phone usually finishes paying in just a few seconds. Shorter lines mean more customers served. More customers served can mean higher revenue. For busy restaurants, grocery stores, and coffee shops, those saved seconds add up throughout the day. Even online businesses depend entirely on digital payments. Streaming services, food delivery apps, ride-sharing platforms, subscription software. None of them could function using physical cash. The modern digital economy simply wasn't built around paper money. So while consumers enjoy convenience, businesses enjoy efficiency, lower operating costs, faster service, better data, and in many cases, higher profits. But businesses aren't the only ones benefiting from a world with less cash. There's another powerful player with an even bigger reason to encourage digital payments: governments. And their motivations go far beyond convenience. Chapter 4: Why Governments Prefer Digital Money. If businesses see digital payments as a way to save time and increase profits, governments see them as a way to better understand the economy. Every time cash changes hands, there's a chance that transaction leaves no official record. A plumber gets paid in cash. A yard sale happens over the weekend. A local vendor accepts only bills. Many of these transactions are perfectly legal. But because cash is difficult to trace, it's also easier to hide income, avoid taxes, or conduct illegal activity. Digital payments work differently. Every transaction creates a record. When money moves electronically, banks and payment networks document when it happened, how much was spent, and where it went. That information helps governments enforce tax laws and reduce financial crime. Another advantage is fighting counterfeit money. Modern U.S. banknotes include advanced security features, but counterfeit bills still circulate every year. Digital payments remove that problem entirely. A digital dollar can't be photocopied or printed in someone's garage. Governments also use payment data to better understand economic activity. They can measure consumer spending, identify economic trends, and respond more quickly during financial crises. During emergencies, digital payment systems can also speed up financial assistance. Instead of mailing paper checks, governments can send money electronically, allowing eligible recipients to receive funds much faster. At the same time, many central banks are exploring something even bigger: a new form of government-issued money designed specifically for the digital age. It's called a central bank digital currency, or CBDC. Unlike cryptocurrencies such as Bitcoin, a CBDC would be issued and backed by a country's central bank. It wouldn't replace the US dollar. It would be the US dollar, just in digital form. Supporters argue that a digital dollar could make payments faster, cheaper, and more accessible. Critics worry it could give governments unprecedented visibility into how money is spent, raising important questions about privacy and financial freedom. Whether or not a digital dollar becomes reality, one thing is clear: governments around the world are investing heavily in digital payment infrastructure. Not because paper money has stopped working, but because digital systems offer new possibilities that cash never could. Still, there's one question that often gets overlooked. What happens when those digital systems stop working? Because despite all the convenience, a world without cash comes with risks that many people don't think about until it's too late. So, if cash still offers important advantages, Will it ever disappear completely, or will it continue to exist alongside digital money for decades to come? Let me know in the comment section.